All right, we're live. Thank you for joining me. I'm Mitch Goldberg. I'm an experienced financial advisor with the wealth management firm Client First Strategy. You know, this is our 20th year in business. Now, we've seen a lot in the last 20 years. And who knew it would grow to what it has become today? Thank you very much to all of you who've joined our journey. Some of you as clients, some of you as wonderful supporters, some of you as our trusted vendors, and of course, all of you who took the time and continue to take the time to watch our content, our live streams, and to join us in all that. I took a little hiatus the last couple of weeks. You had some stuff going on. I don't know if you know this. On a personal note, I had a death in the family, my older brother, and another person I was very close with. So it's just been a pretty tough time, and I have to say the second half of 2024 has been pretty rough. Still had a good year. I still found lots of joy, and I hope you did too. But I am looking forward to 2025. I'm not saying I'm wishing the time away. Time is precious, and I always wake up every day and say, I wish I had more time because there's so many things that I want to do. I love learning and learning how to play guitar. I'm learning how to play guitar for a long time, but it's a journey and I love doing it. I work out. And I hope you guys all have your things that you enjoy doing too. I enjoy hiking. I'd love to know what you enjoy doing. So leave me a note in the comments what you enjoy doing. Say hello. Let me know you're out there. I want to talk about tariffs, bonds, and creating a portfolio that is sustainable throughout your retirement. These are pretty big topics, and I think each topic in and of itself is worthy of its own live stream. But I'm going to see if I can cram them all into about a 10-minute or 8-minute session here. So here goes. First, I'm going to roll a quick 20-second intro, and we're going to first talk about bonds and bond funds and why, for me and for many of my clients, I prefer individual bonds. We'll talk. I have my notes here. What I'm going to show notes. I want to talk to you a little bit about losers and winners in the market this year, and maybe some really contrarian plays out there. And I do want to talk to you a little bit about tariffs. All right, that's an important topic. So let me roll a quick intro, and we're going to get right into it. Here we go. Thank you for joining me. I'm Mitch Goldberg with Client First Strategy. Let's talk about bonds first. Now, many of you, many of you buy bonds as in a product like a mutual fund or an exchange traded fund. The point about those products is instead of buying individual bonds, you get a package of bonds. You get lots of diversification, lots of bonds. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. But here's the thing. I will tell you that the bond funds that I follow, ETFs, mutual funds, are ever since interest rates went up from 2 years ago to where they are now. I'm talking long-term rates as well as the short-term rates that are controlled by the Federal Reserve. You know, bond funds have been losers, and I really don't see people recovering in these bond funds unless you see interest rates go all the way down to zero again. And unless the Federal Reserve wants to start on a new round of money printing called quantitative easing, which I really don't think there's any appetite whatsoever for the Federal Reserve to do this. The Fed has grown its balance sheet from $800 billion before the Great Recession to, I think it's like $5 or $6 trillion today. So it's a massive balance sheet. So the Fed has electronically created bonds, printed money, put it into the environment, into the economy to get people to spend money, to lower interest rates. So people, if you're not making any money in your money, you might as well spend it. And it was all to fight something called deflation, which was a worry. And we took care of that pretty good because then we went into inflation. Inflation jumped up pretty high, hitting 10% at one point. But that was for like literally for a hot minute. It wasn't like we had sustainable 10%. Inflation's been running around 2.5% by most measures, consumer price index. It could bounce up a little, bounce down a little bit, but it is getting very tough to bring that any lower than where it is now. But the Federal Reserve, who controls short-term rates, that's the body who that controls short-term rates, is saying they'd like to see inflation come a little down a little bit more, but they're still cutting interest rates now. It's a whole thing. I don't want to get into Fed policy, but I do want to talk about bonds. If you buy a bond fund, and there are bond funds for treasury bonds, that mature in 7 to 10 years, treasury bonds that mature 20 years, that take 20 years or more to mature. There's corporate bonds, municipal bonds. There's all kinds of bond funds. The thing with a bond fund is there's no maturity date. With a bond, you invest in it, when you're getting your coupon payments. Typically, bonds pay interest every 6 months, and then at maturity, you get your principal back. So if you buy a $10,000 bond that pays 5%, you get $250 every 6 months. And when the bond matures, you get your $10,000 back. And at that point, you could reinvest it into another bond or walk away and do something else with the money. With a bond fund, there's never really a maturity. It's just as bonds mature, they get reinvested into new bonds, up and down, whatever interest rates you're doing. And across the board, I could tell you the losers across the board are bond funds. And I realized it was very tough to buy a bond when interest rates were really low, but bond funds were really low also. And I just think that the need for a bond fund is not as great as it used to be. There was a time where if you weren't going to buy like at least 50 or 100 bonds, let's say $50,000 or $100,000 worth of bonds at once, you didn't really have any business buying bonds. It was a very inefficient market. You probably paid a higher price for your bonds than if you just bought a bond fund, because a bond fund manager that's running, like $10 billion worth of bonds is going to get bonds at a much cheaper price than you. But those inefficiencies have pretty much gone away in very similar fashion to what happened to the stock market over the last 30, 40 years. The efficiencies of decimal trading, for example, of what market makers can do and all the regulations that have made the stock market a much better, much more level playing field for investors. The same thing has happened in the bond market. And when I buy bonds for clients, they're actually checked against prevailing bond prices for the same bonds elsewhere, so that clients get the best possible price. And now you could buy one bond. I mean, when I go and buy treasury bonds for clients, I see one bond offerings. There are plenty of times where you see bonds offered anywhere from 1 to 100 bonds. You want to buy 22 bonds, you can buy 22 bonds. You want to buy 41 bonds or 6 bonds, you can do that. You want to buy one. So I don't really see the need as much to buy a bond fund. With bonds, I like to know that they're maturing, I'm getting my money, and I can reinvest. And if I have a client today who comes in with a lot of money to invest, and 20% of the portfolio is going to go into bonds, for example, let's say $1 million portfolio and 200,000 into bonds, I would rather buy a mix of individual bonds with maturities ranging anywhere from maybe 6 months to 2 years, maybe some at 5 year, 10 year, depending on the client's needs. The other thing with individual bonds is I could time the maturity. So if I need money in 15 years for a particular goal, I could buy a bond today that matures in 15 years, and I just know that money is locked up, put away, and I will get my interest on it when the bond matures. The money will be there for me. That's the sort of thing that I like to do with bonds. Bonds are subject to certain risk, and primarily interest rate risk, which is bouncing off of inflation. So if you buy a bond, interest rates could go lower, and then in that case, you'll be happy that you have the bond because your bond value will go up, and you know that you got a good deal for interest rates. Most of you who buy a bond are not selling your bond when it goes up and reinvesting into another bond. Most of you who buy a bond hold on to maturity regardless of what the price of the bond does between today and the time the bond matures. In other words, A bond has an end life. It's called the date of maturity. So if a bond matures in 5 years, you get your money back. The bond is no longer a useful financial instrument. It just means a company or the government borrowed money, or a municipality borrowed money from you. For, let's say, in this example, 5 years. At the end of the 5 years, they pay it off. You get your money back. Now you could sell your bond, but before maturity. The risk you run is that if interest rates and inflation go up, you might sell the bond for less money than what you paid for it. So when I talk to clients about bonds, I'm talking about holding on till maturity, and I have a discussion with clients and saying, how long could we have this money tied up for? And if a client says, I might need that money in, a year, well, maybe we'll go into 6 month, 9 month, and 12-month bonds. If a client says, no, I'm not touching that money, I'm planning on leaving that for the long term, 10 years or more, well, then that could be different kinds of bonds in terms of maturity for that client. And if the client is living in a high tax state and they're in a high tax bracket, I might buy municipal bonds instead of treasury bonds. It all depends. For clients buying bonds in an IRA, I even just today bought municipal bonds for a client in an IRA. You might say, well, why would you buy tax-free municipal bonds in an IRA? Well, because sometimes municipal bonds are taxable. Not all municipal bonds are tax-free. And the ones that are taxable sometimes have decent ratings, are insured, and pay a higher yield than prevailing treasury bond yields. So sometimes it's actually a pretty good deal. But this is what a good financial advisor will do for you. A good advisor, he or she will go and find the right bonds for your portfolio and do a little homework. So I prefer individual bonds over bond funds. It used to be that it was an inefficient market, and for a small investor to buy 20 or 30 bonds or less, you were getting ripped off when you bought your bonds. That's a fact. It was a very inefficient market. But today the market is very efficient, like the stock market, and now you could literally buy one bond if that has a role in your portfolio. So individual bonds rule the roost. The funny thing is, very few financial advisors that I know actually buy individual bonds. They're all just somehow stuck in bond funds. Now, I'm not saying bond funds are a bad thing. Some clients, it's the right thing. But I know here, my partners and I, Bobby, me, Andrew, we like to buy individual bonds for our clients. But we will always make sure that it's the right bond, the right product, for the right situation, for the right client. So let's talk now about tariffs. Right now, with the Trump tariffs, and Biden kept them, a little bit of changes, but basically they're pulling in about $80 billion of revenue for the government annually in the last year. And that pays for about 2 weeks of government operations. It would be really, really hard to pay for government operations and all the things we need to do strictly based on tariffs. Now, targeted tariffs could work and they could be helpful. And you're hearing that a lot. I like targeted tariffs. I don't like blanket tariffs. So let me explain something about tariffs. When there are tariffs, you and I pay more for those goods. Someone once said to me, so I don't care if I pay, $10 for a shower curtain at Target instead of $9. What's the big deal? Yeah, but 9 to 10 is about, a more than 10% increase. So if you're paying a 10% increase on other things that you buy, it starts to add up. And estimates I've seen can be anywhere from $1,500 to a couple $1,000s for a family of four if tariffs are enacted in the ways that Trump is talking about. Now, if you make $500,000 a year, it might not make much of a difference. But if you're a family of four living on an income of $100,000 a year, $3,000 to $5,000 could be a pretty big deal. So it's a very regressive way, like a regressive tax. Now, before somebody says, oh, politics, what do you know? I do know. I know how the economy works. I know what tariffs are. But let's talk more about targeted tariffs and doing tariffs maybe the right way, not just a blanket way. You see, if you put a tariff on something like, let's say, coffee. We don't really grow coffee in this country. We don't have the climate, the elevations. We import our coffee. So if you put a tariff on imported coffee, you're hurting American consumers and pretty much I'm drinking a cup now. This is still about half full. I'm an optimist. It's half full. Okay. So, that hurts. If you put a tariff on something that we do make here that's also made in China or Mexico, that's a different story because it gives us an opportunity to at least have a replacement that we could buy here. So if you buy a car that's $40,000 in America and a comparable car from another country is, let's say, $40,000, we put a tariff on that, maybe we'll sell more cars here, but at least American consumers would have an option to fall back on in case of tariffs on cars. So you really have to make sure that you're putting a tariff on products that we also make domestically. Because if not, you're not really incentivizing anybody. You're just making people pay higher prices, which hurts consumers and hurts the economy. So before tariffs are enacted, make sure that whether if it's furniture or electronics, make sure that we have viable alternatives. It's one thing to put on a tariff to collect some revenue and to make our American companies a little bit more competitive. But if an American company is not in a particular business, like coffee beans, then what's the point of putting on the tariff? Right? It's just going to hurt consumers, but you're not benefiting American businesses, and you're not going to incentivize American consumers to buy American coffee beans because we just don't have American coffee beans. Hope that example works. It's a little simple, I know, but it's got to prove a point. Just make sure a tariff is on something where we're competing, at least, not just something where we can't even compete, like avocados or certain things that only come from foreign countries. All right. There are just some things that are only grown in certain countries because of certain climates, for example. So let's talk about that. We did talk about that. Let's talk about losers in the market and winners. We're almost up to the end of the year. And we're going into a time when there's two things. Window dressing. That is when fund managers, they know that on December 31st, whatever holdings they have in their portfolios, financial advisors do it also. They want to exit their losers and they want to hold on to the winners, buy more of the winners, because they want their customers, their clients, their shareholders to see that they have lots of winners in the portfolio and not a lot of losers. This puts further downside onto the losers this year, and it helps prop up winners this year. And we go through this process every year. The other thing is, for investors who are so close, we're so close to the end of the year, it's hard to justify taking a profit on a stock when we're just a few weeks left in the year. We could just wait till January, take profits, and put the capital gains taxes off a whole other year. Whereas opposed to taking a loss, we could benefit from that right now. So anybody who's taken a little bit of gains on the big winners this year, some of these big tech stocks, the big artificial intelligence stocks, the names, you talk about them all the time. You have a lot of capital gains. You possibly have a lot of realized capital gains. Certainly the funds you're investing in could have a lot of capital gains also. So it does behoove you to look for some taxable losses, some tax loss stocks. And that just puts more downward pressure on the losers and makes the winners either hold up or go up more. Now, I'm not saying that a stock that's up a lot like NVIDIA can't go down a little bit by the end of the year, but by and large, I'm not thinking that NVIDIA is going to go down 40, 50% between now and the end of the year. But I do see that a lot of down stocks will probably not really catch a bid until the tax loss selling is over for this year. We call that the January effect, where the selling finally abates in the losing stocks because tax selling goes away. And now that the sellers go away, all you need is a little bit of buying power, and a lot of the losers at the end of a year become the winners in the new year. It's called the January effect. That is an important thing for you to know. I wouldn't make every trade based on taxes. I wouldn't let the tax tail wag the dog, so to speak. But I want you to understand the mechanics. Now, there is something to be said, and we've talked about this so many times, about taking gains on some of your biggest winners. It's, when you see your biggest winners, I'm talking especially artificial intelligence stocks. Again, the poster child for that is NVIDIA, but there's lots of others. What if these stocks go down? They're so widely held in the major averages, the major index funds. Okay. You can't invest directly into an index fund, by the way, but you can't. I'm sorry. You can't invest directly into an index, but you could invest into a index fund that tracks or mimics an index. Okay. But if these stocks sort of go down, we're all looking at the value of our portfolios, and a lot of people are sitting around complacent saying, look how much money I have. But it's built up on a handful of stocks. And I do think it pays to be not a total contrarian, but a little bit of a contrarian and say, I'm going to take some profits after you carefully consider whether or not you should with your financial advisor and reinvest some of that money into different areas of the market. By now, if technology is the biggest component of virtually every index, mid cap, small cap, large cap indexes, you have to maybe consider moving some money out into different areas. What about materials? What about industrials? Right? What about financials? There are other places to be. And I think that's important to creating a sustainable portfolio, whereas you take some gains on your winners along the way and use those proceeds to either reduce your stock exposure by reinvesting into bonds or holding on to cash if you have cash needs coming up, or you buy different kinds of stocks in different sectors. I don't mean to, let's say, sell NVIDIA and buy Broadcom, or sell Amazon and, buy AMD or something. Maybe that could be a good trade or not. I'm not recommending that. But what I am saying is, if you're going to sell a tech stock, and tech stocks are now the biggest portion of your portfolio, you don't want to keep taking profits in tech stocks and reinvesting into more tech stocks, in my opinion. You want to reinvest into different areas and be willing to wait. All right. And that is, to me, one of the key ways to create a portfolio that is not just, that doesn't just have growth potential, but also creates, in my mind, a more sustainable way to invest for the long term. A lot of you think these top stocks could do no wrong. But I remember when Cisco and Intel and Lucent were the best stocks you could own back in 2000. Lucent, I mean, it's part of Alcatel now, I think, and it's never recovered. It's like $1 or something. And Intel and Cisco still have not reached the valuations that they once had during the tech bubble. Microsoft was around. Apple was nearly out of business. And I don't know anyone who ever heard of NVIDIA back in that day. So be careful, because it's different stocks that lead the way in new bull markets. And we could have a new bull market in the next couple of years following a really bad recession. That's it for today. Thanks so much for joining me. I really appreciate it. I see some of you are watching this, and it means a lot to me. If you have any questions, reach out to me if you want to have a one-on-one. Have a great day. Thank you.